This chapter is all about trading firms and inventory, which are terms we've used but maybe not explained fully. So let's do that now. Businesses are generally either trading firms or service firms. So a trading firm, that's where our business is here. We buy things from suppliers, and those things are called inventory, and we pay a price. So in this case, $100. And we buy it, get it to our business, and our sole purpose of a business is taking that inventory and selling it to customers, and we sell it for more than it cost us. So as in, if we bought it for $100, we want to sell it for $200, and we've made a profit. So a trading firm is a business that purchases inventory or goods to resell at a profit. So goods are the same thing. And so what's inventory then? Well, they're goods purchased by a trading firm for the sole purpose of reselling to customers at a profit. And you can think of it as being different to an asset which is purchased for the business to use rather than sell, for example, a car or property. So inventory is bought solely for the purpose of reselling and reselling at a profit. That is different to a service firm, which if you did year 11 accounting was actually Unit 1. What's that about? Well, that's where instead of having suppliers providing inventory, we don't have that. We might have it for things like, we buy photocopy paper to use in the printer, that sort of thing. So that is a supplier, but it's not the main thing that we do. The main thing that we do for our customers is provide our knowledge, skills, or abilities to perform a certain task or service. And we add up how much that costs. So let's say we're a painter and we think it costs $500 with all the materials and the labor and everything. And then we paint the customer's house and we charge more than we think it will cost. So in this case, $1,000. So what the customer is getting instead of a good is kind of like an intangible. You sort of say knowledge, skills, ability to do a certain thing. And that's what a service firm does. It's a business that provides its time, labor, or expertise to customers in return for a fee. Now, we don't need to know service firms in year 12. We're just explaining it so we can move on and say, look, we're dealing with trading firms. So inventory is a very important asset for a trading firm. Why? Well, let's just take suppliers over here. Here's our business in the middle. We buy inventory, we put it in our warehouse. But if that's all we do, like that's our whole business is about buying and reselling inventory, well, we don't just have sort of one box of inventory, we have hundreds or thousands of units of inventory. So we can say inventory is so important because it's probably going to be our most valuable asset. So for a trading firm, it will have a lot of money tied up in its inventory, and it will probably be its biggest asset, as in the most valuable, the one that costs the most, maybe except for a property. Other than that, most business, retail or trading businesses, their biggest, most important asset is their inventory. Why else is it important? Well, think about how we make our money. All we do, but the only way we can make revenue is by selling inventory to customers. So we can say inventory is really important because it's our main source of revenue. A trading firm will make most, maybe even all, of its inventory from selling, revenues from selling inventory. So it is important that inventory is managed well. However, inventory is also what we call a vulnerable asset. If you think about a building, now buildings do sort of, devalue in terms of the value probably goes up actually in terms of the market and so on, but the actual property, it sort of wears down over time. But not much, not really. A property doesn't really change too much over its lifespan. It keeps its value or probably goes up. That is opposite to inventory. It's vulnerable because there's a chance the inventory you have will go out of date or fashion. So here's some things that aren't really around anymore. In the 80s, there was a thing called Swatch watches. Everyone had a Swatch watch. They're still around. But look, if you still had some today, they're going to be difficult for you to sell. So that's not good. iPods have been superseded by smartphones, obviously. And this is film. That's how we used to take pictures before we had digital cameras. And then after digital cameras, we had smartphones, which are basically a digital camera as well. So yeah, these are like old, out-fashioned, redundant inventory that we just can't move anymore. However, it's also at inventories, there's a risk of it getting damaged or spoiled. Like if something's made of glass or ceramics, it can literally get broken or damaged. But also perishables, food, some liquids, that sort of thing. They go out of date, so there's really a pressure to sell them quickly. And lastly, inventory is also at risk of getting stolen. So if you've ever wondered why razor blades are behind the counter at most supermarkets or pharmacies, that's because the packet of 8 is probably going to cost you $50, and that's one of the most commonly stolen items in all of retail. And that's just an example, but basically every type of inventory is susceptible to being stolen. So you add these three things up, and we could say inventory is very vulnerable as an asset because unlike a property, there's a risk of it going out of date or fashion, getting damaged or spoiled, or even getting stolen.